Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. What a week it's been in the financial world. We've got markets hitting record highs, a highly anticipated Fed meeting looming, and some truly fascinating stories from the cutting edge of tech and global trade. It really feels like we're balancing on a knife edge of optimism, while beneath the surface, there are some very real underlying concerns.
Absolutely. Our mission today is to take a deep dive into several key sources from Reuters, CNBC, and Bloomberg. We're going to unpack exactly what's driving these headlines and, most importantly, what it means for your understanding of the market. We'll just try to distill these complex narratives into clear, actionable insights, connecting the dots between, seemingly disparate events.
That's the core of it, isn't it? Because the big question we're grappling with this week is, are these record highs signaling a genuine, robust market expansion? Or are they maybe masking deeper interconnected forces, from central bank caution to geopolitical shifts and the relentless AI race? That could lead us into a fascinating, perhaps volatile, next chapter.
Let's unpack this because the headlines are certainly dramatic.
Okay, let's do it.
Let's start with those incredible market highs. All three major U.S. indexes, the Dow Jones Industrial Average, S&P 500, and NASDAQ Composite, closed at record levels on Thursday, hitting new intraday all-time highs. It's been a roar that some, like Jim Cramer, are saying is leaving the cynics baffled. He specifically noted in a CNBC report, the cynics just can't believe what's happening in this market. They're so used to finding reasons to be bearish that they're being overrun by positive events. So what do you make of this idea of cynics being baffled? Well, it's interesting phrasing. What's fascinating here is that this market optimism, despite some recent data points that might suggest caution, it's largely fueled by expectations around the Federal Reserve's upcoming meeting next week. Our sources at Bloomberg and CNBC Daily Open have really highlighted that investors are digesting new economic data, kind of hoping it paves the way for interest rate cuts. The slightly less obvious takeaway here is that the market isn't necessarily reacting just to current conditions, but it's heavily betting on what the Fed will do. It seems driven by a strong belief they'll be, ahead of the curve in lowering borrowing costs.
Okay, so this optimism is primarily a forward-looking bet on the Fed. But what does this all mean for the Fed's actual decision-making? We've seen a mixed bag of signals, a surprise increase in weekly jobless claims, and a revision to non-farm payroll suggesting fewer jobs created than initially thought. That's according to Reuters. Yet the Consumer Price Index rose, with August CPI up 0.4% for the month, pushing the annual inflation rate to 2.9%, with core inflation at 3.1%. And the Fed's target, of course, is 2%. So how does the Fed navigate these conflicting currents?
Yeah, that really raises the core question. How does the Fed balance its dual mandate, stable prices and maximum employment, when facing such contradictory signals? On one hand, you have signs of a cooling labor market, which, would typically give the Fed room to cut rates. Makes sense.
Right.
But on the other hand, inflation, particularly that core inflation number, is still stubbornly above their 2% target. The market, as you said, is currently anticipating a significant 90% chance of a 25 basis point rate cut next Wednesday. That's a quarter of a percentage point cut.
90%. Wow.
Yeah, it's priced in heavily. Some economists like Neil Dutta from Renaissance Macro Research are even arguing for a larger 50 basis point cut, pointing to what they see as rapidly cooling labor conditions. Now, this is a critical point because, historically, 50 basis point cuts outside of recessions are exceptionally rare. I mean, there's only one instance since 1990, which was actually just back in September 2024. So if the Fed were to make such a deep cut, it would signal a much deeper concern about the U.S. economy's near future than the current bullish market sentiment might suggest. That's the real implication for you to consider.
And to add another layer of complexity here, we're also seeing political pressure on the Fed. CNBC reported that President Donald Trump, who has frequently pushed for rate cuts, recently asked an appeals court to allow him to fire Federal Reserve Board Governor Lisa Cook before next week's meeting. A lower court, however, blocked this move, citing the public interest in Fed independence. How does this political backdrop color the Fed's decision-making process, which is, supposed to be purely data-driven?
Indeed. And this really highlights the sensitive environment the Fed operates in, where economic signals meet these political currents. Their independence is, well, it's a cornerstone of their credibility, and any perceived interference only amplifies the scrutiny they're under. The updated economic projections they'll release next week will give us more insight into how policymakers view the path forward. especially after some officials had considered a stagflation risk earlier this year. Remember that scenario? High inflation, high unemployment, and stagnant growth.
Yeah, that ugly mix.
Exactly. While that extreme scenario seems to have receded, the updated data we're seeing this week, it appears to be pushing them more towards concerns about stagnation rather than persistent high inflation. It's a subtle shift.
Okay, so while the Fed navigates these intricate domestic pressures and political currents, it's not operating in a vacuum. In fact, some of these very dynamics, like the need for government funding, are creating entirely separate but equally critical liquidity challenges in the money markets. Wall Street, for instance, is reportedly bracing for potential quarter-end liquidity stress in money markets this September. What's behind this September squeeze concern that Reuters wrote about?
Right. That Reuters analysis highlighted investor concerns about a potential September squeeze in funding markets. This concern stems from a surge in U.S. Treasury bill issuance, which essentially sucks cash out of the banking system. It has to go somewhere.
Hmm.
When that's combined with large corporate tax payments and Treasury debt payments due around quarter end, it can really tighten the supply of available overnight cash. That drives up borrowing costs in the money markets. And it sort of echoes September 2019 when overnight funding costs spiked, forcing Fed intervention.
Right, I remember that.
Now, while some liquidity measures like the Secured Overnight Financing Rate, or SOFR, are signaling a bit of stress, it rose to a 2-month high last Friday. Bank reserves are much higher than they were in 2019. We're talking $3.2 trillion now. And critically, the Fed's Standing Repo Facility, or SRF, which is essentially a permanent backstop where banks can swap treasuries for cash that's also in place now as an emergency liquidity tap, that's a tool they didn't have readily available back in 2019.
So does this mean there's a genuine difference of opinion on how severe this might be? Are we seeing a true division of expert opinion, or is it just different interpretations of the same data?
It's a bit of both, I'd say, but perhaps with a leaning towards caution. Teresa Ho from J.P. Morgan expresses concern, suggesting we can't just ignore the historical precedent from 2019. However, Nafis Smith of Vanguard believes worries about a 2019-style disruption are, in his words, overly pessimistic, suggesting any pressure will likely be short-lived. Jonathan Kuhn from Nomura, also quoted by Reuters, notes something interesting. Funding markets rarely blow out when risks are well telegraphed. Why? Because the market actively prepositions.
So they prepare for it.
Exactly. The key insight here is that when risks are known, the market often adapts in advance, which can actually prevent the need for direct Fed intervention. The market sort of self-corrects to a degree.
Okay, so while the Fed grapples with domestic signals and the money market's health, the global picture is equally complex, especially when we look at how trade policies are impacting businesses and nations alike. Let's talk tariffs. The U.S. Treasury Department reported, with details seen in Yahoo Finance, that tariff revenue neared $30 billion in August. That's the first full month of President Trump's reciprocal tariff regime. These duties range from 10% to 50% on various imported goods. The impact is palpable, isn't it?
Oh, absolutely. This move has direct, often painful implications for businesses. For example, the luxury furniture company RH lowered its full-year sales guidance. They cited tariff uncertainty as a big problem, and, as CNBC reported, its stock fell significantly in after-hours trading.
Out.
Yeah. The key insight isn't just that one company suffered, but that tariff uncertainty creates this pervasive planning challenge. It forces businesses to prioritize supply chain flexibility and resilience, maybe over pure cost optimization. For many global players, that's a fundamental shift in strategy they're having to make.
And this isn't just a U.S. phenomenon, is it? Speaking of tariffs, CNBC also reported that Mexico is planning to raise tariffs on vehicles coming from Asia, particularly China, to 50% from the current 20%. That's a huge jump.
It is, and China's Ministry of Commerce has warned Mexico to think twice, threatening countermeasures and stating China will take necessary measures to resolutely safeguard its legitimate rights and interests.
Strong words.
Very. This is a significant development, especially since Mexico has actually been China's top destination for car exports, according to China Passenger Car Association figures. This move from Mexico seems like a clear response to the broader global trade tensions, maybe seeking to protect its domestic auto industry, or perhaps align with other trade partners like the U.S. Furthermore, Reuters noted that China's central bank is also taking steps to better regulate cross-border yuan financing and promote its offshore use. Now, this isn't just about trade, it reflects a broader strategy to reduce reliance on the US dollar amidst these global dynamics. We're connecting dots here between different financial and geopolitical strategies. It shows a push for greater financial autonomy and potentially shifting global power balances. It really shows how interconnected these seemingly separate decisions are.
It truly is a complex global picture. We also saw, according to CNBC, the European Central Bank hold rates at 2% on Thursday, and the UK economy recorded zero growth in July, adding to the Bank of England's considerations for monetary policy next week. Every major economy is navigating its own unique set of challenges, often with a cautious hand on those monetary policy levers.
That's right, everyone's treading carefully.
Now, let's shift gears from these macroeconomic and geopolitical forces to the accelerating world of technology and innovation, which continues to drive significant market moves. Oracle had just a stunning surge, adding $244 billion in market value on Wednesday. CNBC highlighted that. That's a staggering amount of value creation in a single day.
That Oracle surge, yeah, it was fueled by massive cloud deals, and it truly illustrates the scramble for computing power in the AI race. It's just intense. It's a strong indicator of how rapidly these developments are taking place, and the immediate market reaction, as Reuters also pointed out. The sheer scale of capital being allocated to build out AI infrastructure is just immense. In fact, Bloomberg reported that OpenAI and NVIDIA CEOs are planning to announce billions of dollars in UK data center investments next week.
Billions more. Oh,
Billions more. It emphasizes the global scale of this build-out. It's not just happening here.
And in related news, SK Hynix, a key supplier for NVIDIA, announced, according to CNBC, it's ready to mass produce its next-generation HBM4 chips. Why are these chips so critical to the AI landscape?
Okay, this is huge because HBM4 chips, high bandwidth memory, they are absolutely crucial for AI computing, especially for NVIDIA's next generation Rubin architecture. Their stacked high bandwidth memory design allows for much, much faster data processing, which is a significant bottleneck in current AI systems. Think of it like a wider highway for data.
Got it.
SK Hynix expects to double its HBM sales this year, further solidifying its what they call commanding position in the HBM market. They could potentially secure 50% market share by 2026. This just reflects the intense demand for advanced memory in the AI sector and highlights how these specialized component races are really defining the next era of technological competition.
Meanwhile, regulatory scrutiny is keeping pace with innovation, it seems. We also have Microsoft sidestepping a hefty EU fine. They agreed to unbundle its Teams workplace communication platform from its Office products. This comes after an antitrust investigation following a complaint from Salesforce-owned Slack, as CNBC reported.
Right. And this demonstrates the ongoing regulatory scrutiny of tech giants, even as they innovate at breakneck speed. Authorities are keenly watching to prevent monopolistic practices in emerging markets like AI. But speaking of innovation paying off, Adobe also posted an upbeat revenue forecast, as both Yahoo Finance and CNBC noted. It suggests a clear payoff from integrating AI features into its software tools, with annual recurring revenue from AI-influenced products surpassing $5 billion.
$5 billion from AI features alone.
Exactly. This shows AI directly translating into significant business growth, even while they navigate these regulatory headwinds.
And for those of you who keep an eye on new market entrants, the crypto exchange Gemini Space Station, founded by the Winklevoss brothers, priced its initial public offering at $28 per share. That values the company at $3.3 billion, with trading set to begin on NASDAQ under the symbol GEMI. This IPO comes, as CNBC highlighted, despite Gemini reporting widening losses, another crypto play defying traditional metrics.
It's fascinating, isn't it, how investor appetite for new tech, particularly in the crypto space, remains high, even with challenging financials. This isn't just an investment, it's a clear bet on future growth and market positioning in the evolving crypto landscape. It demonstrates a willingness to look past current losses for potential long-term gains in what is still, let's be honest, a highly speculative but potentially transformative sector.
Okay. Finally, in innovation, the space economy is really heating up. Amazon's Project Kuiper is playing catch-up with SpaceX's Starlink in the satellite internet race. Kuiper secured its first in-flight Wi-Fi contract with JetBlue, while Starlink recently agreed to that huge $17 billion deal to buy EchoStar's wireless spectrum licenses to bolster its 5G business. These details come from a CNBC report on investing in space. It's the race for the final frontier of connectivity.
Absolutely. This shows the intense competition and massive investments pouring into low Earth orbit or LEO satellites. That same CNBC report notes 70,000 LEO satellite plans slated to launch between 2025 and 2031. 70,000.
Wow.
Yeah. They're anticipating 6G communications and connecting billions who currently lack internet access. The key insight here, I think, is that space is becoming the next big infrastructure play. It's driven by fundamental global connectivity needs, far beyond just consumer internet access. Think industrial, governmental, everything.
Fascinating. Let's quickly touch on just a few other company highlights that caught our attention this week, demonstrating how individual stories fit into these broader trends. Johnson & Johnson, for instance, is performing surprisingly well. Its stock is up more than 23% year-to-date, despite the broader healthcare sector lagging, according to CNBC.
Yeah, that J&J resurgence, as Jim Cramer pointed out on CNBC's Mad Money, seems partly due to a perceived shift in its legal strategy regarding the talc lawsuits. They appear to be moving from trying sweeping bankruptcy settlements to actually fighting cases in court. That, combined with the underlying strength of its diversified drug and medical device portfolio, particularly in cardiovascular care and new cancer treatments, it just shows that sometimes a strategic shift in how a company handles its major challenges, not just product innovation, can drive significant performance, especially when it's underpinned by strong core businesses.
Good point. We're also seeing the intense competition between Eli Lilly and Novo Nordisk in the diet drug market, as highlighted by CNBC. Eli Lilly is down 2% this year, while Novo Nordisk is down almost 37%. Big difference there.
Yeah, big swings. These individual company stories, from supermicrocomputer shipping NVIDIA's latest AI solutions, a point Yahoo Finance noted, to RH grappling with tariffs, they really demonstrate the diverse factors influencing market performance. Each company navigates its own specific headwinds and tailwinds within these broader market trends. It reminds us that even amid record highs, not all ships rise equally with the tide. Some definitely struggle more than others.
What an eventful week as we wrap up our Friday deep dive into the financial headlines. From Jim Cramer's bullish arguments against market cynics to the intricate dance of the Fed, the geopolitical ripples of tariffs, and the relentless march of AI innovation, it's clear the market is navigating a complex and dynamic landscape. So much going on.
Absolutely. I think the key takeaway here for you listening is to observe how these seemingly disparate events, market sentiment, central bank policy, global trade disputes, technological breakthroughs, how they are all interconnected. They're shaping the financial world in profound ways. Understanding these connections provides a powerful lens for navigating the information overload and for truly making sense of the market's current, perhaps paradoxical state.
So, as we head into the new week, what will be the next big shift to truly capture investor attention? Will it be the Fed's decision next Wednesday? A new development in the AI race? Or maybe an unexpected turn in global trade? Something to consider as you reflect on this week's news and how these current trends might evolve.
Always something new around the corner.
Thank you for joining us for this deep dive. We'll see you on Monday morning with new headlines from major financial magazines.